Section 3:1 Introduction to Beta, Applications of Beta. 3.1 Portfolio Construction and Asset Allocation. Beta can be a useful tool for constructing a diversified portfolio based on risk tolerance. By incorporating assets with different beta values, investors can manage their exposure to systematic risk and tailor their portfolio to their desired level of risk. Here's how beta can be used to construct a diversified portfolio. Assess risk tolerance. Begin by determining your risk tolerance, which is the amount of risk you are willing and able to take on in your investment portfolio. Risk tolerance depends on factors such as your financial goals, time horizon, and personal comfort with volatility. It's important to be realistic and align your risk tolerance with your investment objectives. Understand beta ranges. Familiarize yourself with the range of beta values for different asset classes and individual securities. For example, equities typically have higher betas compared to fixed income securities. By diversifying across assets with varying beta values, you can manage your exposure to systematic risk, define asset allocation, determine the target allocation for different asset classes in your portfolio based on your risk tolerance and investment goals. A common approach is to allocate a higher percentage to assets with lower betas, example, fixed income, and a smaller percentage to assets with higher betas, e.g., equities. This allocation aims to balance risk and return based on your risk tolerance. Select investments with varying betas. Within each asset class, select investments with different beta values. For equities, consider a mix of large cap, mid cap, and small cap stocks, as well as securities from different sectors or regions. Within fixed income, diversify across government bonds, corporate bonds, and other fixed income instruments. By including investments with a range of beta values, you can further diversify your portfolio's risk. Monitor portfolio risk. Regularly monitor the overall beta of your portfolio to ensure it aligns with your risk tolerance. Adjust the portfolio weights of different asset classes or individual securities if needed. Rebalancing the portfolio periodically can help maintain the desired risk level and account for any changes in market conditions or your risk tolerance. It's important to note that beta is just one factor to consider when constructing a diversified portfolio. Other factors, such as the correlation between assets, fundamental analysis, and diversification across other risk factors, should also be considered. Additionally, it's advisable to seek guidance from a financial advisor or investment professional who can help tailor the portfolio construction process to your specific risk tolerance and financial goals. Beta plays a significant role in determining asset allocation strategies. It helps investors determine the appropriate mix of assets in a portfolio based on their risk tolerance, investment objectives, and desired level of exposure to systematic risk. Here's how beta influences asset allocation strategies. Risk and return trade-off. Beta is a measure of an asset's systematic risk, representing its sensitivity to market movements. Higher beta assets tend to have greater volatility and potential for higher returns, while lower beta assets tend to be less volatile with potentially lower returns. Asset allocation involves finding the right balance between risk and return based on an investor's risk tolerance and investment goals. Diversification. Beta is a tool for diversifying a portfolio across different asset classes and securities. By including assets with different beta values, investors can diversify their exposure to systematic risk. Diversification helps reduce the impact of individual asset performance and can enhance the overall risk-adjusted return of the portfolio. Combining assets with low or negative correlations can further enhance the diversification benefits. Tailoring risk exposure. Beta allows investors to target specific levels of systematic risk in their portfolio. For example, investors seeking higher risk portfolios may allocate a larger portion of their portfolio to assets with higher betas, such as equities. Conversely, investors with lower risk tolerance may allocate a larger portion to assets with lower betas, such as fixed income securities. By adjusting the allocation to different beta values, investors can align their portfolio's risk exposure with their risk tolerance and investment objectives. Strategic asset allocation. Beta can guide strategic asset allocation decisions, which involve setting long-term target allocations to different asset classes. Investors can use historical beta data to assess the risk-return characteristics of different asset classes and adjust their allocation weights accordingly. For example, If an investor believes that equities will outperform bonds over the long term based on historical beta values, they may allocate a larger portion of their portfolio to equities. Tactical asset allocation. Beta can also inform tactical asset allocation decisions, which involve making shorter-term adjustments to the portfolio based on market conditions and expectations. By monitoring changes in beta values and market conditions, investors can adjust their allocation weights to take advantage of potential opportunities or manage risks. For example, during periods of high market volatility or increased systematic risk, investors may reduce their exposure to high beta assets and increase their allocation to low beta assets as a risk management strategy. It's important to note that beta is based on historical data and may not fully capture future risk and return dynamics. Other factors such as company-specific information, macroeconomic factors, and market conditions should also be considered in asset allocation strategies. Additionally, investors should regularly review and adjust their asset allocation based on changing market conditions, investment goals, and risk tolerance. Seeking advice from a financial advisor or investment professional can provide valuable guidance in determining the appropriate asset allocation strategy based on beta and other relevant factors.